Okay, welcome to everybody that's able to join me. I'm very pleased to be with you again this evening, this beautiful evening, to share with you a couple insights that we're seeing in the market right now in the economy and questions I'm sure you have about the projection of the stock market, projected legislation changes, planning that you might need to do, law changes, tariff impact, our current administration having the president that we do, independent of who you voted for. What's that impact? So we're going to dive into all of that in the subject we're going to call Your Retirement in Focus, Navigating Markets, Policy, and Planning in 2025. So here's the agenda for today. At a high level, there's three topics I want to touch base on with y'all. First one, market conditions and what would be an appropriate investment strategy for now moving forward based on our current menu of investments. Secondly, what does the economic landscape look like? That goes into inflation, tariffs, trade war, GDP, debt, and then tax planning and estate planning. A couple laws will be expiring shortly. What do you do about that? There's also a couple new strategies that I have in here that you may not have heard of before that are now appropriate for this time frame. So with that said, we have a lot to cover. Let's start with the markets and your investments. Last year was a very good year for stocks. I think most of us have seen that or experienced that. The index climbed to over 20%. So far, the economy has proven resilient and we avoided a recession. And as we head into 2025, experts are suggesting that we temper our expectations. Returns will not be like they have been, so they're saying. And because stock prices ran up so much to begin with, we still consider prices to be somewhat expensive. And so it's not likely we'll see another 20% return in the stock market. Something in the mid to upper single digits might be more realistic, according to forecasts. On the bond side, the story has changed a lot over the past couple of years. It's actually the bond yields are some of the highest that we've seen. For example, 10-year Treasury yields around 4% range recently, much better than the 1% we had for a long time. And we'll see what the impact of that is. Surprisingly, some analysts are even projecting that the returns on bonds might be better over the long term versus stocks. However, right now, with uncertainty, the bond market is volatile. There are mixed signals about inflation and interest rates, and the Fed potentially adjusting rates, all things to take a look at. And so, overall, the economic outlook for 2025 is cautiously positive. Growth is expected to continue, just at a slower pace. And to emphasize again, we don't see an obvious recession on the horizon right now, but we do have a new administration and possible policy changes that could impact markets and other aspects of your financial plan. That brings me to how would you have your investments allocated in a time like this? How do you protect your money? The good news is that the classic balanced 60-40 portfolio is kind of back in style. For a while, it wasn't a hot thing to do because having 40% of your money in bonds that were earning 1% wasn't very secure. And then we had a couple market downturns with bonds, particularly, which made it even less safe and lucrative, especially not keeping up with inflation. Now, last year, we've had interest rates higher for a little bit of time now. Your average 60-40 portfolio earned roughly 10%, showing that that balance now, the 60-40, can perform. Okay. And as we move into 2025, if the Fed begins to gently lower rates, bonds are expected to hold their own, even outperform cash savings. Diversification, our second topic here, like any time in the market, super important to be diversified. And I think we've discussed that. You've been taught that as an investor, and it really holds importance now. Now, what you're diversified to is vitally important. Now, whether it's US international stocks or emerging markets, or buying disruptive growth areas like AI, cybersecurity, cloud computing while they're low and cheap, or even involving private credit or real estate or dividend paying stocks, maybe even commodities like gold. All of these things are important in a portfolio now compared to before. Now, fortunately, many of you, if not all of you, except for a couple extra I invited on tonight, we work together long term. And so your portfolios have been structured to withstand a calamity. We haven't faced a calamity yet, even though it might feel like we are, getting anxious about our income and when to buy and sell for income. We'll get to that in a second. But you are structured to withstand a storm. I would say differently than your regular general investment company, where they focus on accumulation. We focus on preservation. And so we're always thinking about how do we protect the downside. The third one here, risk and return alignment with income needs. At this stage, we know, as I just mentioned, protecting what you have is just as important as growing it. And many retirees automatically opt for a conservative portfolio, maybe 50 or 60% in cash or bonds, especially if they don't want to worry about big swings. Others who have more of a long-term horizon with investing might be the opposite, might still be somewhat aggressive. Now, what I'm suggesting is a good approach here moving forward because of so much volatility is you might want to keep 1 to 2 years worth of cash sitting in the bank, more than you might think you need. For example, if you usually keep 3 months worth of cash, maybe you want to keep six. If you keep six, maybe you want to keep 12. Stretch yourself, keep more than you usually would. And I'll go through basket planning in a second, which can be a mighty way to invest your money in different baskets to get your income. So let's jump right into that. How do we manage that volatility? That's a whole part of retirement planning. Having cash reserves, we just talked about that. One of the ideas with this bucket strategy by time horizon is I want you to imagine you have three buckets, just three, side by side. 1, 2, 3. The bucket closest to you represent conservative and liquid investments. And that would be the bucket you tap if you need a year or less worth of income. That would be money market. Sometimes annuities can be in there because you can take penalty-free withdrawals. That can even be certain types of CDs. You name it. The second bucket, which would be in the middle, so the second farthest from you, that is your traditional growth bucket, growth and income bucket. That's where you'd have investments that you do want to grow to outpace inflation. You do have some income generating assets in there to create income for the future. So that second bucket having the time frame being between 1 and 3 years. So having something that's actively creating income and growing now that you don't have to touch now, and instead, when it grows, scraping off the icing and putting it in your first bucket for income, and then putting that into money market or something conservative, preparing it to be used for your income. And then the farthest bucket from you, the third bucket, would be the most aggressive bucket and had the longest time horizon. Three, maybe some commodities, disruptive growth territories, and maybe small cap stocks, things that typically have more volatility. And you don't have to tap, and you can lose or you can go down with that account, and you have time to bring it back, and you don't have to touch it for any reason. And then having it set up like manufacturing station where things are just being passed down to people. Instead, the baskets with hands are passing the money they earn down to the next bucket and the next bucket. And so eventually you have your first basket or bucket in front of you for income that's constantly being replenished in a strategic, monitored way so you don't have to tap your market when it's down. We've integrated that into your portfolio. Very important part to have right now because without that, when the market goes down, you have to tap your investments. Now, this one might seem simple as well, balancing and self-discipline. I have to tell you, it can be very tempting when markets go down to want to sell out or move to cash. Even more so now because you and I know that what we're going through is, I have to say, a little bit unprecedented. It is unique in a way. And you might think that my reaction or your strategy must also be unique to counter that. What I say is the things that are causing market volatility right now, they may be unique, but how the market's reacting is not unique. And so the ways we approach that should be what we standardly do, and that is rebalancing. For example, stocks have a great year, you might end up with 70% in the stocks when you intended 60. So rebalancing means you would sell a bit of that excess and move back to your original allocation. It's a disciplined way to sell high and buy low systematically. It also forces you to take profits from winners and bolster the parts that may have lagged, the underperformers, which might be poised to do better long term. Main point here is to avoid the knee-jerk reaction of volatility, the anxiety that can come up. We can't predict market ups, we can't predict market downs. Trying to time the market is extremely difficult and usually counterproductive. I say usually because there are people out there that get lucky, or they say they have a gut feeling about getting out. And sometimes they may succeed at that, and they will run into something called confirmation bias. They'll say, I knew this was going to happen, and I moved out and I succeeded. Usually those same people, and I've talked with them, and I think they've done a fantastic job back in '08 when something was really hard to predict. People, they didn't get out. And so keep that in mind because someone else is doing something different from you. And it's seemingly working. Doesn't mean what you're doing is not working. With that said, let's jump into the economic landscape and go over some statistics together. You know, with everything going on, tariffs, interest rates where they're at, Social Security being talked about, taxes being going up shortly, there's a lot of economic factors we need to consider. Our current inflation stands at about 2.4%. That's not bad, especially when historically our inflation has been anywhere between 2.7 and 3.3. That's what I would consider normal. Now, what people don't understand about inflation is just because it has a low year for inflation doesn't mean that the rocket's not still going up. Okay, every year inflation does increase a little bit, a little bit. It very rarely goes down. So it's always a threat. Now, Federal Reserve stance, the Fed has maintained interest rates between 4.25 and 4.5. Okay, which creates some concerns over economic uncertainty and potential stagflation, which is a combination of very stagnant growth and rising costs. Social Security COLA, the COLA living cost of living adjustment for Social Security beneficiaries is 2.5% for 2025. So it barely outpaces current inflation. But as we're about to see, with tariffs, prices, we suspect will start going up. And this inflation number, I suspect, will change. Will definitely change. The other thing that's been the hot topic right now, because we haven't really seen the full consequence for it yet, are tariffs. We have implemented significant tariffs. You see it on the news. We have 145% tariff on Chinese imports, 25% on cars, steel, aluminum from Canada or Mexico. And these tariffs have led to increased costs for you, for me as a business. They're disrupting supply chains, and they have contributed to a contraction in US GDP for the first time in 3 years. Now, I'm not bashing on the people that are doing this. In some way, there is reason behind why things are being done. In some other ways, perhaps not. What I can tell you is right now, because of inflation suspected to go higher and these tariffs, fixed incomes may not keep pace with rising costs. Okay. And what I'm most concerned about, and what you might be concerned about, are your essential expenses, the things that you have to spend money on. So you as a retiree might need to consider or reassess your investment strategies to include assets that offer inflation protection. For example, right now we're using something called Niagara Income Opportunities. And the price of that asset doesn't fluctuate, it's very flat. What it does is it pays a dividend quarterly. And that quarterly dividend is 2.5% right now. So for the year, you get 10%. It has gone up since last year when it was 8. That's a very quick and easy way to outpace inflation for this year and get the income that you need. Niagara income. You all have a part of Niagara because you all expressed interest in Niagara. But you might want to shift more money to it. For example, a fellow family member of the Zenith retirement community, we were talking several weeks ago about the impact of the stock market and its volatility on her anxiety. And she's always had this anxiety, and we work very closely together to make sure that she feels safe and okay. And her investments were already very conservative, very conservative. But just knowing that headlines were changing her investments, I gave her an option. We can keep going down this path. You're in a safe path. Or we can just put your money into Niagara Income Opportunities. You'll make fixed amounts of money, and headlines won't change your portfolio. And she decided that's exactly what she wanted to do. I called her up the other day. She's at the grocery store. I asked her, "How are you feeling about things?" She said, "Oh, well, fine. Good, actually. Don't really check the news anymore." She doesn't have to. So keep that in mind. The other thing here, um, with consumer prices, the tariffs, of course, are leading to those higher prices for goods. And those trade tensions as well contribute to stock market fluctuations, potentially impacting your portfolios. The US dollar is also depreciated this year about 9%. That's high. And with the declining value of the US dollar internationally, even here, we're being assessed the US dollar if it can serve as the world currency when it has depreciated so much. And then, of course, with the declining cost of the dollar compared to um, inflation, can be a concern. So, with that said, let's move on to some other topics, tax and estate planning. And I think we're right on time here to finish up shortly. The one thing that I'll make known to you for being here in North Carolina with me is state taxes. They do vary across, different states. But here in North Carolina, we've been on a schedule for tax rate cuts for state taxes for a couple years now. Carolina's flat tax rate is now 4.25%, which is great. It's going down. It does help a little bit. Iowa, if you're familiar with Iowa, moved to a flat 3.9%. Arizona's a flat 2.5%. Other states like Mississippi, Missouri, Nebraska, or even West Virginia also lowered their rates or restructured their brackets in 2025. They've been flush with revenue, and many have passed tax relief. So if you're moving to a different state in the near future, I would definitely recommend looking into that. Now let's talk about estate planning. This area will be seeing significant changes in the next year or so. The federal state tax exemption, that's the amount that you can pass on to your beneficiaries free of any federal state tax, is at an all-time high. 2025, the exemption is 14 million per person. So if you're married, that's $28 million combined you could pass on to your beneficiaries without any tax consequences. So given this very high bar, very few states, only the super wealthy, currently have to worry about that, which is if they're above 28 million, then they have to pay a pretty substantial tax. And right now, it's estimated that under 1% of households actually have to worry about the federal state tax. But this is scheduled to change after 2025 and 2026. The Tax Cuts and Jobs Act, you've probably heard me talk about that. It changed tax rates, and in 2026, tax rates are bent to go up as well if nothing changes. But it also did something to the estate tax exemption. In 2017, the Tax Cuts and Jobs Act increased the exemption by double. It used to be much lower. It used to be about 5.6 million per person, and they doubled it to 11.2 back then. So, what's going to happen? 2026, this is going to expire, and it's going to be cut in half. So that $5 million plus inflation back then will be about $6.5 to $7 million now. So what that means, the exemption could drop from $14 million to 6 to 7 million, which is 14 million altogether now. So now if you have over 14 million, then you'll have to pay the estate tax, which is 40% on any amounts above the exemption. So what does that mean? That can be very terrifying for some of us. We've been working together, especially with our estate planner lead, to address this already with many of you. And you might think right now that only billionaires have to worry about that, but in 2026, suddenly estates in that, like I said, $14 million range will have to deal with this. And so what you can do about it is think about where your money's at right now, your age. If your money doubles, let's say every 10 years to be conservative now, where would that put you? This might not change your plan at all. This might totally change your plan. So 2025 is a critical, very critical time to address estate planning and to prepare for this event. That brings us to Roth conversions and the current tax rate environment and something called qualified longevity annuities. So because taxes are set to go up in 2026, based on what's been passed so far, there was a funny little death to tax bill that was passed that it's been passed, things like that have been passed before. They don't get usually approved. Besides that, no other word has been officially stated. Nothing has been passed to address the expiration of tax rates. So what that tells me so far is that they're very busy. But if Trump can sign all the bills that he's trying to pass, I'm sure he would have thought about this. That's my philosophy. And again, I'm independent. But something will have to be addressed. If it's not addressed this year, then we might see in a temporary extension where tax rates this year are the same for next year. And then we'll have to deal with the consequences after. Or something does get passed that extends our current low tax rates long term. We don't see any of that yet. So as it stands right now, taxes in 2026 will be higher than they are right now, anywhere from 1 to 4% more. So what that means is if you're doing a Roth IRA conversion strategy, it might make sense to take some of that money. Or if you have a retirement account and you need income and you know you need it for this year and next year, you're better off taking the money this year because you'll save You're basically able to discount shop in your retirement account now before you pay full prices next year. And that could be huge depending on what your goals are. Now, the qualified longevity annuity is a special type of annuity. We use annuities with Zenith Retirement for safety of principal to protect money, generate income, and usually you can get a reasonable return out of them. So they're very popular. This one is different. The main point of this type of annuity is to protect yourself against longevity risk, which is the potential that you might live too long, if there is ever such a thing. But it's also the potential that you might not have money later. So these types of contracts were created. Now, what's special about them is if you really want to defer tax, since we're on that topic, you can put up to $200,000 in one of these, and your required minimum distributions won't start until 85 for that amount. Right now, it's between 73 and 75, but if you put it in there, you can actually postpone RMDs on $200,000 to age 85. Those are kinds of ideas we're thinking about now. There are many ways out there, and we've been slowly introducing them to you, especially because these ones that have been talked about so far are the most applicable. There are different ideas that just don't fit where we're at, don't fit your philosophies. And so most of them are for business owners, but slowly and surely new things are coming out that can be used. So, with that said, let's conclude here and send you off to have a very pleasant night. Market side, remember the economy in 2025 is on solid footing, but the ride will be choppy. It has been, and I think it will continue to be. Not expecting a recession right away, but slower growth. But you should brace for the volatility and expect it. And if you ever get uncomfortable about it, give me a call and we'll talk through it. I'm very happy to do that at any time. On the tax and estate front, we had a little bit of a golden moment for tax planning the last couple of years because we suspected that what's happening with tax rates next year was going to happen. So we've been doing Roth conversions. Estate planning will also change as well. So it's a good time to look at your estate planning. And lastly, the overarching advice here, right, is to keep your plan current. Your investment committee with Bison and Chief Investment Officer Justin Bowler looks through all the curated menus of investments out there. He adjusts the economy. He's analyzing data. I'm also doing my own research. We come together and we have a pretty good understanding of what's going on and we pass it on to you. That's really important. If your other key members in your team, if you have a CPA you use that isn't our CPA or even an attorney, and they want to have, a conversation to get caught up with what's going on, I'm happy to do that too. Please use me as your resource. You have a lot of firepower over here, and I would love to use all of it to help you. So with that said, that is our discussion for tonight. And as always, running these private workshops for clients only has been a privilege, and every month we're going to have them. Next month will be about something similar to this, more so on the investment strategy and planning front, more ideas on what you can do right now to alleviate discomfort, to outpace inflation. But keep me in your mind, keep me in your heart. If you have any worries or you want to talk about anything, I'm just a phone call away. And many of you have already given me calls or texted me or emailed me, and we talk. Even if you need more of that, I'm here for you. With that said, please make it a great evening, and we'll talk to you soon.